Mr. Gupta, of course, the chairman and managing director of Havells India. Last time we spoke to you was when you were, announcing your new factory in Rajasthan and taking advantage of the Atmanirbhar movement with air conditioners. But looking at the earnings, the first question I think the markets will want to know, okay, the festive demand has been encouraging. Post that, where is demand at? We're in the midst of a, Omicron wave 2.
Well, I guess, as you rightly said, that the post the second wave and the festive demand was generally a good growth period. And that was continued, over the last couple of years. So overall, 2 year CAGR has been encouraging. But due to the rise in COVID cases during the second half of December, we saw some tapering down. January also saw some lockdowns in certain parts of the country. So there was a little bit of tapering of demand in the second half of December and the first half of January. And that's a little bit of more of, I would not really say that tertiary demand is still down because construction is still open. But there is a little bit of slowdown in terms of pickup by the trade. Hopefully now with the third wave being mild, we should be expecting normalized growth coming back in second half of February, March. That's what we're expecting.
Mr. Gupta, it's not just for you, it's across corporate India. Rising inflation, rising input costs that is squeezing out margins. We've seen some companies that have been able to pass on the higher cost to consumers. Some have not been able to. Can you share with us what your trajectory is and is likely to be when it comes to margins?
Well, as far as RM cost is concerned, I've always mentioned that it's been an unprecedented rise in raw material cost over the last 1 year or so. And hence, in certain product categories, some of them we have been able to pass on, like switchgears, lighting, cables and wires. And consumer durables is the festive or the seasonal demand is about to come in the coming time. And last couple of years have been a tepid growth for the consumer durables because of the season not hitting, or at least the COVID waves hitting during the season time. So we are expecting the cost pass on to happen sometime in the next couple of quarters, and hence the margins should be coming to normalized levels over a period of time. We do expect that this growth in raw material prices would taper down or at least stabilize over the next couple of quarters.
Mr. Gupta, consumer durables and electricals, most companies have already taken a considerable price hike in the past few quarters. Wanted to understand how much more of a price hike can you really take without hurting your volumes and demand?
Yeah, this has been, a global inflationary trend over the last 1 year or so. And yes, it should affect the demand as well. But however, there are some positive tailwinds as well. So construction industry continues to do better post the COVID waves. The industrial and infrastructure segment has started showing good response. So while there could be some slowness in the overall tertiary demand from the consumer side, but at least the project side and the industrial side is kicking in. So I think overall should be a good mix. But yes, definitely inflation has been unprecedented.
Mr. Gupta, Lloyd's has seen a decline in growth this particular quarter. What can we expect in Q4 since the summer season is around the corner? And whether or not you are seeing early demand trends actually look up?
As far as Lloyd is concerned, it's I think if you look at the 2 year CAGR, it's very healthy. It's over 25%. And so that is an indication that the last year base was a high base due to many factors. As far as seasonal demand is concerned, we are definitely expecting a very good summer this time, given the fact that COVID had hit both in 2020 and 21 during the peak season time. So we are expecting not only a pent-up demand, but a good demand coming in the summer season. The initial trends are still a bit slow, as I said, second half of December, January, because of the third wave, things have been slow, but we are expecting things to start coming back to normal levels in February and March.
As well as washing machines, they've been the new additions to the consumer durable side. So give us a sense as to how the initial trade channel reaction has been.
Well, I guess I would say that the trade channel response has been extremely positive, both in refrigerators and washing machines. Washing machines, the new in-house production also kicks in now. So that should also, increase the possibility of adding more models and range in the coming times. However, it'll take its own time to build up a certain volume, which will, give a balance to the entire portfolio of Lloyd. Air conditioners continue to remain the mainstay, and it is a journey which will take about 3 or 4 years to pan out, to not only be accepted well by the trade, but also by the consumers.
And are there any supply side risks that you're still facing, and how is the company mitigating these risks?
So far, so good. The only I would say the negative is the cost inflation. Otherwise, from a supply point of view, we are fine.
Thank you so much, sir, for taking out time for us. First let's put out this quarter. First half there was no price hike, but there was an inflation hike which probably came in the raw material. And second half you've taken a steep price hike. So what has been the impact of that? And then we can take it forward.
So overall, actually in the first half as well, we had taken about close to about a 7% hike as well. And in the quarter three, we have taken two hikes, one in November, the other one is in December, totaling up to a total about 15% hike to that extent. So overall, what we have seen is that sequentially, the profits have really gone quarter on quarter to that extent. And we have also looked at a very, very strong volume growth, which has come for the quarter of 18% and a value growth of 26%. So overall, I think the top line has been very, very healthy. Quarter to quarter, the margins have gone up because of the price hike which has been taken. And so has been the EBITDA margins in a very strong way. So I think we are on a very good footing now, because we have taken the whole pressure of the inflation head on with respect to the price increases to that extent. In the year, total increases have been to the tune of about 22% now. And we are well within the kind of inflation what we had seen to that extent. And therefore, I think going forward, the next quarter looks good from the point of view of addressing the inflation bit.
I think this would be the highest ever price hike that the company has taken in the history. With that 18 to 20% volume growth, how commendable would you say is that for somebody who says that demand would get hit if even a large market share company like Asian Paint would take a price hike?
Yes, I would agree that the price increases have been unprecedented. We have never seen earlier that we would have taken this quantum of a hike going forward. From that point of view, we kind of paced out our prices in November and December. But having said that, I think it is quite strong, the volume growth we have been able to get, and so is the value growth, because what we see is that the months of October and November were very good for us, given the fact that the festive period in October was good. The COVID pressure was off to that extent. The consumer sentiment was quite good. So overall, what I would say that even in the month of December, we got a little bit hit in the second fortnight of December because of the third wave kind of really emerging. But overall, I would say very, very healthy volumes, very good value growth, and we would have definitely gained a good quantum of market share in the quarter three as we see forward.
Just in terms of Q4, the full impact of price hike, and what do you expect in terms of the wave 3 to have an impact? What has been the experience from the previous waves? It just gets postponed and not finished?
See, now we have been experiencing COVID for the last about, almost 1 year and 9 months, so to say. And I think the experience has been that definitely there is an impact on a consumer sentiment, which happens immediately when such a wave really starts. But overall, what we see is that by and large, there is only a little bit of a deferment of the sale, which really happens because people don't really put off their painting or the renovation cycles which are there. While this is a discretionary area, but we still see that it is only a deferment which happens. And therefore, our outlook is very clearly that as we kind of go forward, it might be that in the month of January, we might see some impact. But going forward, I think the quarter in the months of February and March should recover from the point of view of, the sale coming back strongly.
Can you just talk about really the trend in the raw material prices? Of course, last 18 months would have been unprecedented for you and difficult in terms to maintain with the sharp price hike. But do you think the rate of price increases in raw materials will now subside or maybe take a U-turn?
So overall, the inflation this year has been very high. From quarter to quarter is what we have been seeing, that there have been increases. Even in quarter 3 over quarter 2, we saw an increase of about 4 to 5% happening to that extent. Going forward, what we see is that the environment is still inflationary. We've just seen price hikes or the crude really hitting the high. So what we see is that some of the crude derivatives might go higher. Some prices on certain select raw materials might come down. So overall, what we see is that the impact of Q4 over Q3 would be mild. We don't think so it will be very, very high, but the environment still would remain inflationary.
Right, sir. Thank you so much, sir, for taking out time for us. Always good to get perspective from you.
At the start of the pandemic, when everything looked very bleak, especially for the economy, rural India was a silver lining. Not only did it seem more resistant to the first wave and a bit of the second wave as well, but consumption was robust. In part, this was driven because of the large number of migrant workers that chose to go back to their towns and villages. It's perhaps a function of that higher base that we're now seeing a slowdown in demand in rural India. There could be several reasons. One of them also is the spike in commodity prices, which is making it difficult to buy several items which are not really or necessarily essential. And the biggest proof really is the results that have been put out by one of India's largest FMCG companies, HUL. HUL has put out robust results in quarter 3, beating estimates in fact, but the commentary from the management shows that the dip in demand in rural India is definitely a matter of concern. Listen in to what Sanjeev Mehta, CMD of HUL, said.
When you have this kind of inflation, then the consumers, and certainly consumers who are at the bottom half of the pyramid, they titrate their volume because the money is limited, and they would focus on what is the most essential, and that's what they buy. And so from that perspective, clearly we are seeing now a slowdown happening in rural area from a volume perspective. Obviously, this would require putting more money in the hands of consumers. That's the best way to get the consumption going. And that would mean, I would believe that the government, the steps that they took in the last 2 years, many of those steps would have to continue. Yeah, even the Manrega outlay, the government should think about not only continuing, perhaps increasing it. Because at the end of the day, a large section of our population lives in rural area. And it is very important. And many of the FMCG products are basic necessities, right? So that indicates the purchasing power and the inherent strength of the rural economy.
To speak more about what is happening with rural India slowdown and why it's a matter of concern, I'm joined today by Sanjay Manyal from ICICI Securities. K. Ramakrishnan, Managing Director, South Asia at Kantar, is speaking with us on the show, and Mayank Shah from Parle is also speaking with us. Let me begin, Mayank, by getting your perspective. I gave a few examples in my opening comments in the show, and we're seeing that across sectors and FMCG companies as well. What has been your experience?
I've said this thing earlier as well, and even at the cost of being repetitive, I would like to reiterate that we need to look at rural demand right now in view of or through lens of what has happened last year. So the kind of phenomenal growth that we saw in rural, if we are talking about foods grew at about 16 to 17% in last year. On such a robust growth that we saw last year, we are talking about current numbers, and we should keep that in mind. Also, while we are comparing the rural growth of this year with urban growth, we should look at what happened in urban India in last year. If we talk about, again, going back to the food category, if we talk about growth in food category in last year of urban India, that was just merely about, 5-6%. And it was because of foods that we saw total FMCG, landing somewhere in positive territory across urban and India, urban rural India last year at about 2-3%. Now, on such a robust growth, if we are saying that there is a slowdown in rural, yes, it is. But we need to understand that we cannot expect a growth of 16-17% year on year. So yes, there is tapering of growth. And there are some signs where we have seen that, because of tapering, the demand is not to the tune of what we expected. But we would not really, or I would rather not say that that's really a big cause of concern, given the situation and given the growth rate of last year.
So you're talking about the foods categories specifically, but if I look at things like fertilizer sales, if I look at things like two-wheeler sales or tractors, etc., which also had a robust growth, but we are seeing a consistent slowdown. Two-wheelers actually never really recovered broadly. Ramki, what would your inputs be here across categories, and what could be some of the reasons we're seeing? Is rising prices of essentials one of the factors?
Okay, so in some ways I would agree with Mayank, what he spoke about earlier. One is, first let's talk about the FMCG lens. In the FMCG lens, if you see, I think we're talking about growth slowing down from we have to look at the base effect. I mean, like 2020 was a phenomenal growth year from the point of view of FMCG, whether it's urban or rural, and more so in rural. And on top of that, we are seeing a growth which is not in line, and so therefore we are thinking we are probably concluding that it's not as robust growth, etc. That's one way to look at it. The second way to look at it is the rural has more of a disturbance than otherwise. And what is that disturbance? Like, for example, a whole lot of rural India across the country has been, the governments have been giving away free products, particularly, let's say, wheat, atta, and staples and things like that. And you will see that the FMCG basket is about 75% foods. And within that, about 30% is atta and wheat. So a lot of things being given free tends to, I'm talking about 2020 and then going on from there. So those giving stuff free tends to disturb the basket a little bit. So therefore people buy something more, something less, so that disturbance exists. So from a point of view of all the long-term parameters, whether it's monsoon or whether it's employability or whether it's support prices or anything, we have not seen anything significant for us to say that there is a cause for us to be concerned about rural India. So there's a disturbance, yes. On the top of a very strong base, the growth is not robust enough, yes. But is it something to stay? Is it something that we should be superly concerned about? My answer would be, I would rather say that not. I would allude to what Mayank said to say that it's more of a disturbance. I understand the two-wheeler story, etc. But like you rightly said, it never really recovered from where it went. And there are several other theories about the two-wheeler story and not just about the rural demand. So fundamentals of rural have not changed. I have no reason to believe that rural is in a state of worry or collapse or anything like that. The fundamentals are still strong. And I think it's only a disturbance. That's my view.
Okay, so rural demand has slowed down, but you're saying you're not overly worried about it. Sanjay, what is the perspective that you would bring to this question? Because now you have the demand of an increase in something like Manrega, and we know that the government has been pumping in a lot in Manrega. You have now the demand that let's increase not only the output or the allocation to Manrega, but even the number of days that we give. Clearly, there is requirement for support there.
Yes, thank you for inviting me. So as you mentioned about the Narega here, yes. So if you see the base effect, obviously it was very high, as the other two panelists have also mentioned it. Coming to the Narega part over here is Narega actually was revised, almost like twofold, compared to the budget in 2020, and that was one of the major reasons why rural growth was very high. Despite the fact the Narega number is high from the actual number, it is still below the revised number of the budget in 2020, and that's one of the reasons probably the rural growth might not be as high as it was last year. The other concern, what I would see right now here is that the huge commodity inflation across commodities, and whenever the commodity inflation is so high, you see that the rural growths deaccelerate, whether it is down trading or So there was a last 5-6 quarters we have seen there was a shift from the unbranded to branded consumption. Probably because of the high commodity prices, there would be a pause in a sense in that rural demand, and that probably is one of the reasons why we probably have seen the de-acceleration in the growth rate of rural India consumption levels.
Thank you so much to all of you for joining us today.